Welcome back. Let's have a quick look at what's happening to international markets this evening. Sort of very dour performance from the US markets. The S&P up 0.1% rather. The Nasdaq down 1/5%, and the Dow Jones flat. Maybe everyone's just been distracted by the solar eclipse today. And across the Atlantic, the FTSE 100 slipping back a little bit. The CAC and the DAX also not having a particularly good start. We managed to close in the green, and it was thanks to resources stocks and a couple of retailers. And still with me in studio are Gabran Smith from NEFG and Alex Dace from Mtumbo Wealth. We were talking about the UK markets. Alex, I know you don't have particularly strong views about FTSE 100 stocks, but if there were any sectors to avoid, or any sectors that you particularly liked, which might they be?
Look, I mean, the risks of Brexit is still very, very difficult to ascertain at this particular stage. We simply do not know what the impact will be, specifically on the currency and the local economy. So I would imagine that some of your smaller cap stocks, purely exposed to the UK, could be under pressure. As well as your banking stocks and your property. So I think that's sectors you should be quite careful of, unless the valuations really compensate you for those risks. And you would like to have stocks that may potentially would benefit from a weaker pound. So if you are quite bearish on Brexit. So I think there's a bunch of those opportunities. I mean, the FTSE has actually grown quite a lot since the pound weakness. So I mean, that'll be probably the areas I will focus on.
Gabran, you did mention some resources shares. That's
yeah, lots of our companies are listed there, and we know them well as well. I mean, a company like Glencore is going to benefit from Tesla and all the other electric cars. That's actually more pollution than what are normally guzzleries and so forth. But
such a skeptic you are, Gabran.
Yeah, I'm a hydrogen fan and a platinum fan, so we own some of those. But yeah, you know, we got Glencore in there that makes money out of cobalt and all this lithium and etc. All the other goodies necessary for lithium batteries and solar and electric cars and so forth. So Anglo is cheap, which now if the copper price goes up and you got a bit of an option on platinum prices and iron ore stays okay, then there's some of those companies trading at 6 and 7p multiples, which is not the right way of looking at it, but one price to book is still cheap long-term wise for a company like Anglo. You can look at Glencore, it's not too badly priced as well. Billiton, if you're an energy fan and you think that the world's going to balance on the oil side and it's not going to all go to electric cars over the next 5 years, which is almost impossible. But
yeah. Okay.
There's lots of trades that you can do in the FTSE.
Just before we get to other questions, Sasol came out with its year-end results today, and I wondered what you made of them. And the question I specifically had was, when they talk about the Lake Charles project, which is the huge project that they have in the US, they talked about an internal rate of return of between 7 and 8%, and I think that's kind of reduced a bit from between 8 and 8.5%. But then they talk about their weighted average cost of capital being 8%. So my question is, and this is maybe a dumb question, but if that's your cost of capital and your rate of return is between 7 and 8%, does it actually mean that you make no return?
No, I mean, it's value destructive, so it means your value of the asset will be less than the book value of the asset going forward. So because you're destroying actual returns on the capital you employed in the business. But that's on current assumptions, close to spot and quite conservative. I mean, it will change over time as the actual inputs and prices and currency changes. So you have to take a very long-term view on that particular project. I think it's more likely it will add value than destroy value over a 10, 20-year period than maybe over the shorter term. I think the results, I mean, from production side, volumes were quite good. I think that was quite pleasing to see. Decent cost control as well. And the fact that they don't anticipate any more problems in Lake Charles for now, I think that's also another positive. And the stock is not particularly expensive as well. There is some risks, for instance, the taxes and the likes. But I think that's well priced in, and Sasol, probably for the first time in many, many years, is getting my attention, and I'm starting to get more bullish on the business.
I mean, Gabran, before we all went on air, we were talking about the tax liabilities, and I was saying, goodness me, they're massive. You know, it's 1.2 liability, I think, in this period. Then they talk about an extra 11.6 billion rand for the 2013, 2014 years. That's, you know, so you've still got the years after that. Aren't those, you know, huge liabilities that they face with? The market just seems to shrug those off.
Look, I think where they're now, 350 billion rand market capitalization or 400 billion market cap or something. So if you have to pay 11 billion, it's what, 2.5 or 3% of market cap, and it's not the end of the world, it's a once-off, and they're probably going to fight it for a few years and so forth. So I mean, just the cost of Lake Charles is what, about 100 billion rand.
Yeah. So, I think
so to have a 10 billion charge on tax is not the worst, and the balance sheet's strong enough to survive that. And it's a once-off, and you should probably look past that long-term wise. The share it's cheapest it's ever been on a price-to-book ratio. We know of all the difficulties that they have with the specific project and the magnitude of the project that they're doing. But I mean, if you look 10 years back, they're doing double or more than double what the revenue were 10 years back. So it is a nice growing company over time. They do invest senselessly over time, and lots of people didn't like what they've been doing over the last 4 or 5 years, and Mr. Constable were taking a big paycheck and firing lots of people, losing some IP, and they've changed that as well. So I think they've addressed stuff. They sold businesses for very low P multiples and invested into more expensive stuff like they do now. But over time, it's not a bad business. Nobody can get the commodity cycles on the dot correctly right. You have to take some risks.
Yeah. Okay. All right. So both of you think Sasol's worth a punt at this point.
Yeah.
There's a question on Quantum Foods. We don't talk about this one often. They have many eggs in one basket, basically. So it's a broiler.
I know they bought a few little ones out and so forth from some of the other guys, but they're just so small for our universe. The liquidity on that stock to hold it in a 500 million rand unit trust, which is a small unit trust in South Africa, is just impossible on a liquidity screen basis. They do look cheap on a price-to-book ratio. I can tell you that it's not an easy environment out there at the moment for the chicken guys. We've got bird flu running around at the moment. The one thing going for these guys at the moment are feed costs have halved from what they were 2 years back when the maize price were at 5,000 rand a ton. It's now 2,000 rand a ton. So they got those going, but they got imports still against them, and they got bird flu at the moment against them. So lots of cyclicality in a food industry, which is not the greatest thing to have.
Yeah, I mean, Alex, would you look at any of the? So Quantum is very sort of it's quite specific in the poultry sector. You do have other companies like Astral Foods for Sovereign, although I suppose Sovereign is essentially buying itself out. So I don't know what your other options are, but would you look at any of them at this point?
Yeah, I mean, I like Astral. I think they're going to benefit from the low maize prices going forward, and like similar also to the milk industry, I think there's going to be a lot of consolidation in the chicken industry going forward, and as a result, Astral will be in a better position, growing our market share organically, and as a result have better procurement and so forth, more efficiencies of scale, and also seeing some of your subsistence farmers are actually under heavy pressure because they can't mechanize and electricity costs, and I think that'll play in their hands into Astral longer term. But definitely are going to benefit from the low maize prices in the 2018 numbers, and for me, this is the one I'll pick if I want to play that theme.
Okay. There was a question from the short seller saying, I'm short Clicks and Dis-Chem. They're at very high multiples. Why would you buy them? So
I won't buy them at those prices. They are too expensive for us, but it might stay there for 2 or 3 years and then come down and the earnings catch up, because these guys are still rolling out stores, especially Dis-Chem, I think, has much less exposure to the rural areas in South Africa, and they're going to expand much more rapidly. If they get that right and have a smaller type of shop in the small towns, time will tell. Clicks have basically exposure to all the towns in South Africa, as far as I know. But they just roll out the numbers every year.
Yeah.
It's not 30p multiples justified by 10 or 15% growth, but at the moment there's nothing else. There's no other place that there's any growth stocks in South Africa. It's so difficult to build a portfolio because you always want at least 40 or 50% in growth stocks in a portfolio, and we don't have many of those at the moment.
No. Okay. Alex, I'm going to move on to your stock picks because we're running out of time, so perhaps the next time we can discuss Clicks or Dis-Chem with you. But your pick this evening is Coronation. Interesting pick given a really sort of difficult market environment that we find ourselves in. Yeah,
I think there's been a lot of negativity around Coronation from a sentiment perspective, and we're starting to see operational performance turning around, and I think a combination of negative sentiment and turnaround operational performance makes me quite excited. I think that if for the first time since 2013 we've seen actually net inflows of an institutional side, which is quite a positive. They're open, of course, for new business again there. Performance has also been picking up, so you should maybe earning some performance fees in this coming year. In the last set of results, there was no performance fees, so it was quite similar to 2008 levels. So I think a combination of net inflows institutional, high performance fees, and also the change in the overall mix. I mean, they've got a larger percentage of assets now in retail and in the international business instead of the institution, which is higher margin. And as a result, I think this current earnings is quite a trough level. For dividend yield, probably in the region of 8%. If you compare that to the market, it's very attractive relative to global competitors as well. I think this is the time now to look into Coronation more for short to medium term peak.
Okay. And Gerbrand's going with SPAR. That's quite also sort of slightly contrarian pick.
No, look, they've been sold down heavily to 150 from 210 levels recently, and I think they're up about 168 now. I haven't looked at the graph for a week or two.
But it's 171 actually.
It's at a P multiple, forward P multiple of about 15, historic P multiple of about 16 at the moment. It's probably the cheapest you could have found SPAR in the last 5 or 6 years. It's the cheapest against all the food guys. Pick n Pay, which got problems of their own, is trading at a 23 P multiple and Shoprite at 22. So you're buying this, which I think is higher quality than most. And you had an opportunity to buy them now, and I think you still have an opportunity to buy them for the first time that you get quality stocks at reasonable prices, and you should buy those when you get those around.
Okay, all right. Well, Shoprite's coming after the results tomorrow, so I suppose we'll look forward with interest to what they say. Gerbrand, Alex, thanks very much for joining us this evening. Gerbrand Smith is from MUFG and Alex Dace is from Tumba Wealth, and we'll be back with Stockwatch tomorrow night at 7:30.